In this episode, we are going to talk about the market maker model. It's one of the most powerful ICT concept, which is responsible for almost every major move in the market. Once you understand this concept, you can identify it on your charts and get in sync with all the major moves in the market. So, let's get into it. At the beginning, imagine a simple structure of how a bullish market moves, where price pushes up, pulls back, pushes up again, and then pulls back again. This repeating cycle of impulse and retracement is the foundation of an uptrend. The market, at its core, only does two things. It looks for liquidity at previous highs and lows, and it corrects imbalances created during strong moves. Those previous highs and lows represent external range liquidity, while the imbalances within price action represent internal range liquidity. When we step back and observe higher time frames like the monthly, weekly, or daily, we can clearly see this behavior. Price forms a swing, then retraces into an internal range liquidity area, and from there it expands upward to take out a previous high, which is external range liquidity. This process doesn't happen just once, it keeps repeating. Price continues to pull back into internal liquidity and then moves higher to target external liquidity. This sequence is what defines a bullish order flow, where the market consistently forms higher highs and higher lows. The main focus, however, is not just the trend itself, but what happens during the retracement phase inside the internal range liquidity. That is where the real opportunity lies. If the higher time frame is showing a bullish structure, the logical approach is to align with that direction and look for buying opportunities instead of trying to sell against the trend. Trading against the higher time frame, especially by attempting reversals from external liquidity back into internal liquidity, goes against the natural flow of the market and reduces the probability of success. This is why continuation trades are generally preferred over reversals. When price retraces into a higher time frame internal range liquidity zone, the lower time frame begins to reveal a specific pattern. This is where a market maker buy model starts forming. It is essentially the internal mechanism that prepares price for the next expansion higher. Understanding time frame alignment is important here. If the retracement occurs on the monthly level, the daily chart will show the structure for execution. If it happens on the weekly, the 4-hour chart becomes relevant, and if it occurs on the daily, the 1-hour chart provides the setup. Inside these internal zones, price is not moving randomly. It is building positions, creating imbalances, and setting up for continuation. The objective remains consistent: to move towards and eventually take out the external range high. In simple terms, the market pulls back to rebalance itself and then continues in the direction of the prevailing trend to seek liquidity. So the entire approach becomes straightforward. First, determine the higher time frame direction. Then wait for price to retrace into an internal range liquidity area. After that, drop down to a lower time frame to identify the developing structure, and execute in alignment with the trend, targeting the next external liquidity level. Once this concept is understood, trading becomes less about guessing and more about following a clear and repeatable process. Now, when it comes to actually trading this, the first thing I do is wait for price to reach a higher time frame internal range liquidity area, whether that's on the monthly, weekly, or daily. I'm not interested in anything before that point because that's where the real setups begin to form. Once price taps into that zone, the next step is to drop down to the corresponding lower time frame that aligns with it, because that's where I'll be looking for execution. At that point, I'm specifically watching for SMT divergence. This is a key confirmation for me. When price reaches the internal range liquidity and SMT appears, it signals that a reversal is likely forming from that zone, with the intention of moving back toward external range liquidity. I treat SMT as a requirement, not just an extra confirmation. If there is no SMT, then for me there is no trade. That's a rule I stick to because it keeps me out of low probability setups. What SMT is really showing is the difference in strength between correlated assets. For example, if I'm focused on one asset and it comes into a key internal zone, I'll compare it with a correlated asset. If the asset I'm watching respects a low, while the correlated one breaks that same level and runs liquidity, That tells me something important. It shows strength in the asset I want to trade and weakness in the other one. That imbalance between the two is a strong indication that a smart money reversal is about to take place. Once I see that happen inside a higher time frame internal range liquidity area, I shift my focus to the lower time frame and start watching how price behaves. I'm looking for a clear shift in delivery, signs that momentum is changing, and that price is beginning to move with intent. That's when I start positioning myself, with the expectation that price will expand out of that internal zone and move toward the external range target. Now that step 1 and step 2 are done, the next thing is simply waiting for confirmation, and that comes in the form of a change in the state of delivery from that higher time frame level. On the intermediate time frame, the focus shifts to identifying the last down-closed candle that was responsible for creating the SMT divergence and tapping into the internal range liquidity. This candle becomes very important because it represents the final point of weakness before the market prepares to shift direction. The confirmation comes when price is able to close above the body high of that specific down-closed candle. It doesn't have to be the very next candle, but whichever candle manages to break and close above that level is what validates the shift. Once that happens, it confirms two things at the same time: a change in delivery and the formation of a bullish order block. This point also marks the beginning of what is known as a smart money reversal, which effectively initiates the market maker buy model with the objective of reaching external range liquidity. From a trading perspective, this is where the low-risk opportunity presents itself. The entry is taken from the order block that formed during that shift, typically at the body of that candle. The idea is to enter with minimal risk while aligning with the new direction of price. A common approach is to target a 1-to-2 risk-to-reward ratio for partial profits, while leaving a portion of the position open to capture the full move toward the external range high. Once partials are secured, the stop can be moved to break even, allowing the rest of the trade to run without risk. After the entry, the market begins to move through different phases of the model. First comes the smart money reversal, followed by the low-risk buy, and then the accumulation phase. If for some reason the initial entry is missed, the focus shifts to identifying opportunities within this accumulation phase. At this point, attention is placed on the sell side of the curve within the developing buy model. Here, up-closed candles often form mitigation blocks, which can serve as new areas of interest. To refine entries in this phase, the range of these candles is marked from wick high to wick low and projected forward. Within these areas, the goal is to see price action confirm strength by closing above key levels, followed by the formation of imbalances such as fair value gaps. These imbalances, especially when aligned with mitigation blocks, provide secondary entry opportunities. Additional confirmation can be found through SMT divergence within these zones, reinforcing the idea that price is preparing to continue higher. For even more precision, it is possible to drop down to a lower time frame and observe a smaller version of the same model forming within this structure. This allows for tighter entries and better risk management while still aligning with the overall higher time frame direction. As price continues to develop, it transitions into the reaccumulation phase. This is where expansion begins to take place more aggressively. At this stage, bullish structures and imbalances should be respected, with minimal drawdown if the move is strong. Any newly formed order blocks during this phase are expected to hold, supporting the continuation toward the target. Eventually, the move completes as price reaches the external range high, which was the original objective from the beginning. When all these elements align, higher time frame context, SMT divergence, confirmation through change in delivery, and proper execution within the model, it creates a clear and structured example of a complete market maker buy model playing out as intended. And just like that, you can see how a complete market maker model plays out from start to finish. It all begins with the higher time frame, draw on liquidity, then transitions into the smart money reversal, followed by the low-risk entry, and then moves through accumulation and reaccumulation before finally delivering into the external range target. This is not random price movement, This is a structured model that repeats itself over and over again. In the market, your job is not to predict, but to wait for each phase to form and then execute with confirmation. Once you understand how each stage connects, you stop chasing trades and start aligning with the real movement behind price. So stay patient. Trust the model and focus only on the setups that follow this sequence, because that is where the highest probability trades exist. If you found value in this, make sure to like the video, subscribe to the channel, and I'll see you in the next one.